how's it going today, guys? So I have a brand new thing to bring to you, and this is going to be a guest video on this channel. So I've had a lot of people ask me about doing a video on options trading, and personally, I have no experience in options trading. So I'm bringing in my friend Justin from the Road to the Two Commas Club. He's basically documenting his progress as far as trading with his end result of having 2 commas in his trading account. So if you guys like this video, make sure you jump over to his channel and subscribe and give him some support on his videos. And I will link up to them in the description. But these are the, basically his YouTube channel is youtube.com/2comma club. And then his Instagram account is JRSKATR. So make sure you guys show him some love and jump over to his YouTube channel if you enjoy this video. And if this is something you want to see more of, let me know, and I may have other guests on the channel. So let me know what you guys think, and I'm excited to bring this video to you.
Hey guys, how's it going? My name is Justin Rodriguez, and I'm here to talk to you guys today about call options and put options, just the very basic fundamentals. Before I start, I want to give a special thank you to Ryan for letting me come on his channel and share this information with you. Really thankful for that, so thanks Ryan. Hopefully you guys will learn a lot today, and if you do want to see more, he's gonna be putting a link to my YouTube channel in the description, which is a vlog of me trading on a day-to-day basis. I'm trying to hit a goal of $1 million in my account, and I started 5 years ago with $16,000, and I've been able to build it up in the last 5 years to a little under 60 grand right now is where I'm at. So I'm kind of documenting my journey as like in a vlog format. So you'll kind of just see me doing like day-to-day stuff, but like talking about the trades I'm doing, what stocks I'm looking at, what options I'm looking at. And as I do that, I try to teach you guys as much as I've learned over the years to kind of speed up your learning curve if you do want to get into investing like I did. Because when I started, I knew absolutely nothing, and I literally had to learn like how to buy a stock when I started, and all I did for like the first 4 years was just buy stocks and hold on to them. So I really didn't know much of anything, but that's kind of how I learned. I just kind of learned by doing, and so I bought stocks, I sold stocks, I learned how to do that, and then finally last year I decided I need to learn more strategies to maximize my profits, and so I've been learning more and more, and learned how to do like limit orders, for example. I learned how to do stop on quote orders, dividend reinvestment, and I saw the highest returns I've ever seen last year once I started getting more serious about it. And this year I started learning how to trade options, and I'm already seeing the most profits I've seen ever. So I really want to share this with information with you guys so that if you're in the market and you want to look into trading options, you can consider this and hopefully get a lot of profits for yourself. So thanks again, Ryan, for letting me come on your channel, and let's just get into it. So when you buy an option, you're buying a contract. So let's just pretend this piece of paper is the contract right here. And this is this is one of the options that I currently own. I own a call option on Apple with a strike price of $150, expiration date of October 20th, 2017, and it cost me $2.65 per share to buy this contract. So let's talk about what a call option is, and then we'll go into what a put option is. So a call option is a contract that gives you the option to buy a stock at a specified price. And all contracts have an expiration date, and all contracts are good for 100 shares. So this call, I'll put it up here, this contract that I bought was for 100 shares of Apple, and since it was $2.65 a share, it actually cost me $265 for the contract. So you have to multiply that price per share by 100 to calculate how much you're going to have to actually spend on that contract. Okay, so once you find the stock that you want to buy, so I picked Apple, and you decide whether you're going to do a call or a put. I did a call option because I want the option to buy the shares, whereas a put option gives you the option to sell shares, but we'll talk about that in a little bit. So once you do that, you want to pick a strike price. Now, the higher the strike price is away from the actual current price, the cheaper it'll be for you to buy, because there's more risk on your end that you're taking on, because the higher the spread is, the less likely that stock price will get to that strike price that you set. So the higher you go, the cheaper it'll be. The closer you get, the more expensive it'll be, because it's more likely for that stock price to hit your strike price. And once it goes above with a call option, it's called being in the money, meaning your contract now has value. Even if it expires, it's still worth something, because you can still, let's say Apple goes up to $175 a share, you still have this contract that says I can buy these shares at $150. So that makes your contract more valuable. Okay, and so the other piece of information you want to look at is the expiration date. So again, it's really all about the probability and the risk that you take on. So if you pick an expiration date 1 month in advance, that's pretty risky because the likelihood of that price hitting your strike price, depending on where you set it, if you only give yourself a month of time, it's less likely to happen, which means you're taking on more risk, which means the contract will be cheaper. If you set an expiration date of like 5, 6 months or a year or 2 years, the further out you set the expiration date, the more expensive it'll be because you're taking on less risk because you're giving yourself a lot more time for that stock price to hit the strike price, which is more likely to happen if you give yourself more time. So the more time you give, the more you'll pay, but the safer it'll be. Okay, and so when I bought this contract, it was February 10th of this year, and Apple was currently trading at that time at $132.12 a share. And since the contract was $2.65 a share, I actually purchased 5 contracts. So it was $265 times 5 with the fee of $10.50. So I spent $1,335.50 on this contract. Now today, I'm filming this on April 2nd. It's Sunday today, but we're looking at last Friday's price. Apple is currently right now trading at $143.66 a share. So since the Apple price went up $11, the call option became more valuable because the call option it's more quickly approaching the strike price, and so that's making my contract more valuable. Even though I didn't hit the strike price yet, I still have until October 20th, so my contract is becoming more valuable. So right now, my contract is worth $6.20 a share, and if I were to sell all 5 contracts right now, I would get about $3,100 for it, which is a profit of $1,764.50, which is a 132.12% return. So that is a very high return, as most of you guys probably know. If I were to actually get that return from actual Apple stock, Apple would need to be trading at $306.52 a share for me to get that same return if I just owned the stock. Now, you can probably just, figure that out. That is very, very unlikely to happen between February 10th and now. It's almost impossible for that to happen. So, one of the advantages of buying options is you have the room to make a lot more profit. But with that room for more profit comes more risk. So if Apple's stock price had gone down, my contract would have gone down a lot more in value, and it would have been worth way less, and I would have lost a lot more money owning this option. So you really want to be careful, and you really want to be sure that the stock you're going to buy an option for is going to go up, because you don't want to lose a lot of money. Some of the things you can do to minimize your risk is picking an expiration date further down the line, gives you more time, and also picking a strike price that's closer to the current price. That'll also lower your risk. So you can kind of adjust however much risk you want to take on. You can adjust what strike price you want and what expiration you want. I personally like to go pretty close to the money, and then I give myself a lot of time. I do understand that I have to pay more for that, but it's worth it for me to take on the less risk. Okay, so let's go on. So we talked about the advantages. You can make more profit. Another advantage, though, of getting an option versus buying the stock is it's cheaper. So with Apple trading at $132 a share when I bought it, the option, it only cost $2.65 a share to get the contract. So for one contract, it was $265. I wouldn't even be able to get 2 shares of actual Apple stock for that much. And so it's a lot cheaper, and it allows you to get into that security, that company, investing in that company with a lot less money. And so that's one of the reasons I like options, is because it just makes it more affordable. And if you're willing to take on that risk, then it's a good option for you to do. So again, the disadvantages are you can lose more money, and it's a lot more volatile. So like if Apple stock goes down, you're going to lose a lot more money owning options than you would if you own the stock. So that's one of the disadvantages of owning call options. Now, some of you might be thinking, okay, you have an expiration date of October 20th. Does that mean you have to hold on to that contract and then you have to buy the shares when it expires? The answer to that is no. You can actually trade your contract just like you would trade a share of stock. And you can sell it literally any point in time after you buy it. Between the moment you buy it to the moment the contract expires, you can sell that contract and get out of that position. So you can just trade it just like you would a stock, and that's usually what I do. I don't ever hold my contracts to expiration. I just sell them and take the profit, and then I just buy some more options with that. Okay, so that pretty much sums up call options. So to kind of re-summarize, you have a call option is an option to buy a stock at a specified price, and then you want the stock to go up in value because that'll make your contract worth more, and you can trade it just like you would trade a stock. You don't need to keep it till expiration. You can just trade it like a stock, and you can see a lot more returns from options. But with that, you take on more risk. Okay, so let's switch over to put options to kind of talk about the difference. Now, with a put option, you're buying a contract to sell a stock at a specified price. So if you want to buy a contract that gives you the option to sell a stock at a certain price, you want that stock price to go below that strike price. Because if it does go below it, your contract is more valuable, and then you can sell your put option for a profit. Okay, so what you don't want to happen is you don't want the stock price to keep climbing, because then your contract is worth less and less. And if it expires and the stock price is above your strike price with a put option, your put option is worthless and you lose all that money when the contract expires. So it's literally the exact opposite of a call option. And I don't know if I mentioned this earlier because it's been a while. I've talked a lot already, but the way I remember call is C and B are right next to each other in the alphabet. So call is an option to buy, helps you remember it. And then put, P and S are close to each other on the alphabet, so that can help you remember that as well. All right, so that kind of wraps up the overview of calls versus put options. There's a lot more detail I can go into this, but it would take a lot more time. And there's so many different types of options you could do. There's so many more like terminology and lingo to learn. It could be overwhelming. So what I did is I just learned the very basic, okay, how do I buy a call option? And then how do I sell it? And so that's literally all I learned, and that's what I'm doing. But what we're thinking about doing, Ryan and I, we talked about this, is doing maybe a series of videos with options, just so I can go into more detail without making this like a 50-minute video, because there's things called covered calls I could talk about. There's extrinsic versus intrinsic value. It's just kind of more terminology that you could learn about options. And then like the Greeks that people call it, the quote-unquote Greeks, there's different variables that represent different like characteristics of an option, such as the volatility. And it's just more information, but for a brief overview video, I didn't want to go into that much detail. I just wanted to explain to you real basic, what is a call option, what is a put option, what do you want to happen when you own a call versus a put. And so I'm just going to kind of leave it at that. The last thing I will mention is how to actually buy a call option, because some of you have never probably done it before. And I had to figure this out myself because I couldn't find a video on how to do it when I was looking. But if you are buying a call option, like on Scottrade, for example, I don't know what it is like on other platforms, but I trade with Scottrade. So the way you do it is when you go to buy an option, you buy it just like you would a stock, but instead of a stock where you just click buy and then you type in the symbol, if you're going to buy an option to own, you're going to click buy to open. So you're buying to open your position in that security. So that's why they call it buy to open. And then when you sell that security, you're selling to close your position. And so when you want to sell your option to get rid of it, you would click sell to close and then put in all the other information. All right, so I'm going to go ahead and type in. So I switched from stocks to ETFs. I switched over to options. So you see a few more things come up here, and we'll talk about that. So I'm going to type in Apple, AAPL. And then I'm going to select buy to open because I want to buy some more options to open my position. So I went buy to open, and then here's what I choose next, expiration date. I'm going to stick with the October 20th expiration because I'm going to look to sell my stuff right after the iPhone's released pretty much anyways, so there's no point in me holding on to it after that. So I'm sticking with October 20th, and once I select the call and put, it'll populate the current prices. So let's just go ahead and go to, for example, let's do what one of my calls is at right now, $150. When I select call, there you go. You'll see it pop up. It actually has gone up in value since earlier in this little video. So it's actually up now. But watch what happens when I choose a higher strike price. So let's say I go to 160, and then I select call. You can see the price went down. And that's because, again, there's less of a chance of Apple hitting 160 than it has from hitting 150. So because you're taking on more risk, because there's less probability of that happening, it is cheaper to buy the option. So instead of over $600 per option, this is $335 per option. And I think the other one I have right now is 165. And so we'll see what that price is. see it's a little bit lower, so $230 per option. And so let's see how much I can afford. I'm just gonna go to calculator here. So I'm gonna type in 2286 divided by, the price was $2.30, so $230 per contract. So that means I could buy nine more contracts. I can afford 9 more contracts. So actually 9 is one of my favorite numbers. So let's just do it. So let's just go ahead and do it. So I'm gonna hit 9 for number of contracts. October 20th at the 165 strike price, call market, which means I want to buy it right now. And there's other options you could do like limit and but we don't need to get into that right now. It's a little bit more advanced. So I'm just going to do market, review order. And so it'll cost me $2,000 with my commission. So you can see how the commission is a lot more than $7 for options, and I'm not sure why they do that, but it probably has to do with the fact that it's more risky. So they just, or maybe it was because I bought 9 contracts instead of 1. I'm not 100% sure, but that's really not too important because I'm just showing you how to actually buy an option. So I'm going to click place order here and then market order placed. And it says, thank you. You ordered 9 contracts. And then I can just go ahead and minimize this. And then right here, when I hit refresh, it'll show that I sold my AMD shares. And then for some reason it split this up. I guess apparently when I did the order, I don't know, by the time it executed, the price changed by a penny apparently. So it split it up into 2 separate orders, but the commission is still total the same. It's still going to total the same amount. It doesn't charge you double commission. So I'll hit refresh here and you'll see my balance will drop down. And then if we go here and hit refresh, we can see that I now own 39 call options for Apple instead of 30, because I actually owned 30 before that. So I own quite a bit. I have quite a bit of money invested in Apple right now. I got about $9,000 in this option, and I have $3,200 in this option. But Apple's doing well today, so we're doing pretty well today so far. This is not the exact number because it just added this into it, so it's not completely accurate. But we're still doing pretty good today. So yeah, so this is kind of stuff I show in my vlog. Whenever I do a trade, I usually will film it and talk about it. So if you guys want to learn more, you definitely can. All right, sorry, that actually went kind of long. So I'll try to cut it down in editing so I can send it over to Ryan and he can throw it in the video before he uploads it. And then, yeah. All right, guys, take care. All right, so that about wraps up my part of the video. Hope you guys learned a lot. I'm going to pass it back to Ryan, and if you are interested in checking out my channel, Ryan's going to leave a link down below in the description. Would really appreciate if you checked it out. Very thankful for Ryan for helping me out with that, and thank you guys for watching, and I hope you guys learned a lot, and we will see you around.